Astral CEO Chris Skutter has lambasted the newly announced Competition Commission inquiry into the poultry sector. He's described it as an attack on the industry. Participation in the inquiry is a costly exercise, as firms will have to provide copious amounts of evidence, attend public hearings and retain legal teams. And that comes as the sector continues to struggle under the weight of load shedding, erratic water supply and bird flu and imports, all of which have contributed to worsening financials for the players in the sector. Skutter says that the Commission should launch an investigation if companies are making 15 to 20% profit margins, not when firms are struggling. Skutter says Astral's margins are 1 or 2%. He believes government should instead be helping the industry thrive so that it can grow and create jobs. Sirius Real Estate has expanded its portfolio in Germany. It's acquired 2 business parks in the country and paid 40 million euros to seal those deals. The transaction will be funded from the proceeds of a recent capital raise. CEO Andrew Coombs says the acquisitions align well with the firm's strategy of curating a range of flexible out-of-town light industrial products that it expects to appeal to the local market. Sanlam is on the verge of buying Bacher. The Competition Commission has approved the deal, and the tribunal needs to give its final stamp of approval. Sanlam is executing the transaction through its private equity firm SPE Fund General Partner, which is controlled by Sanlam Investment Management. SPE has been active in private equity investing since 1998 and manages a portfolio of more than 3 billion rand on behalf of the Sanlam Group and third-party investors. Bacher is the distributor and wholesaler of household brands such as Tommy Hilfiger and Hugo Boss. Financial details of the deal have not been disclosed. Ascendis Health's offer of 80 cents a share to buy out shareholders and delist the firm is fair. That's according to a new report by financial advisory firm BDO. The report was commissioned by the Ascendis board after ousted chair Harry Smith published a presentation on X which revealed that insiders believed that the firm was worth far more than the offer to minorities. BDO looked into the presentation but nevertheless concluded that the firm is worth about 84 cents a share. Calgro M3 is eyeing higher year-end profit. The affordable housing and memorial parks developer says its headline earnings per share will increase by at least 20%. It cited a prudent financial allocation and says this is a result of a reduction in the company's issued share capital, as well as the operational performance of the group's divisions. Calgro is set to open its books in May. Further afield, according to sources, NVIDIA is building a new business unit focused on designing custom chips for cloud computing firms and others, including advanced artificial intelligence processors. Let's take a look at this report for more.
NVIDIA is building a new business unit focused on designing custom chips, including advanced artificial intelligence processors for cloud computing firms and others. 9 sources who spoke with Reuters said the dominant global designer and supplier of AI chips wants to move into an area with tremendous growth and protect itself as companies are searching for alternatives to its products. NVIDIA currently controls about 80% of the market for high-end AI chips, a position that has sent its market value up 40% so far this year to more than $1.7 trillion, after it more than tripled in 2023. The company's customers, including ChatGPT creator OpenAI, Microsoft, Google, and Meta platforms, have raced to snap up the dwindling supply of NVIDIA's AI chips, while they try to develop their own chips for specific needs. NVIDIA is trying to help them and gain a foothold in a $30 billion market, putting it into competition with Broadcom and Marvell Technology. In 2022, NVIDIA said it would let third-party customers integrate some of its proprietary network technology with their own chips, and the company refused to comment beyond that to Reuters.
And the European Union has reached an agreement on spending rules which are said to help the region boost investment. Let's check in with our reporter Darling Lachela and the DW team for further insight.
That's right, Zinati. The bloc's parliament and member states reached a deal on reforms to budgetary rules. And joining us with on-the-ground insight is DW correspondent Chiponda Chimbelu in Berlin. Thanks for your time today. Now, Chiponda, let's start right at the top. Tell us about these new rules and what they bring.
Thanks for having me. Well, the reform aims to allow for more flexibility when it comes to defense and climate spending. Basically, the aim of these new rules is to boost investment, but at the same time, keep spending under control. Until now, government debt rules in the EU have been governed by the Stability and Growth Pact. Now, these are rules that were set up in the 1990s with the goal to limit countries' debt to 60% of GDP and public deficit to 3%. Last year, the average government debt to GDP ratio in the EU was just over 80%. Greece, Italy, France, and Spain were among the countries that were way above the national debt rules that were set in the 1990s. So the revised rules will allow countries with excessive government borrowing to reduce their debt gradually, and they will also get more time to do that.
And why is this deal so important in the EU?
Well, the new agreement will create a path for countries whose government debt levels or deficits are excessive. This deal is really about updating the EU's fiscal debt rules, and looking at some of the government debt levels that we see, it is quite clear that for many countries, the old rules do not reflect their fiscal realities. Right now, European governments need to invest heavily in defense and the green transition. So it is quite clear that the bloc's debt rules needed modernizing. Negotiations for this agreement have taken 2 years. While countries like France and Italy advocate fiscal flexibility, frugal countries like Germany have been calling for strict targets to reduce debt. And we've also seen this discussion play out here in Germany at the national level with a government debt brake. The rule aims to limit government borrowing to prevent future generations from bearing too high a burden of government debt. But some German lawmakers within the government feel that the debt brake needs to be lifted for the country to be able to tackle the ongoing economic challenges and invest in the green transition. So it will be interesting to see whether the EU agreement influences Germany's debate on the debt brake as well.
Now, when will this agreement actually take effect?
Well, the EU deal still needs the approval of the 27 national governments and the EU Assembly for it to become law. The expectation is that that will be a formality. It was the German government that had been holding up the deal that was reached, and so this agreement is expected to be endorsed by the national governments and the EU legislature. The new rules will take effect from 2025, and the period for countries to cut their debt and deficit will be extended to 7 years from 4 years.
Let's leave it there. Thanks for those insights. That was Chiponda Chimbelu from Deutsche Welle.